Welcome to Our 2 Cents on Your Dollar, the podcast brought to you by Strategic Insights, where we break down the numbers, decode the noise, and offer smart takes on money matters so your financial future makes sense. Deep in the recesses of the One Big Beautiful Bill Act lies a sneaky little serpent that is looking to retain 10% of your gambling loss deduction. So for the remainder of this show, we're going to talk about what this provision is. We're going to talk about what it could potentially do for prediction markets. And we're going to talk about just overall taxation of gambling and maybe some strategies and tips around all that.
Yeah.
So what am I talking about?
Yeah.
So as of right now, you can only deduct up to 90% of your gambling losses up to your gambling winnings. So for example, if you have $10,000 of gambling winnings, you can only deduct $9,000 of gambling losses. So you'll be left with $1,000 of phantom income, which is subject to ordinary income taxes.
Yes, which is different than the way it used to be, right? So the way it used to be was you were able to deduct all of your losses up to the full amount of winnings. So if you made 10,000 and you lost 10,000, there was no phantom income. And so now obviously this is starting an uproar, as far as the gambling world is concerned.
I thought nobody had losses. So it doesn't even matter.
But
Nobody on this show.
But the way this works now is that you have to pay some income on money that you don't have in your pocket, really.
I'm glad you said everyone's in an uproar because I think it's unjustified. So why is everybody in an uproar, and why do I believe we believe it's unjustified, right?
Yeah.
Yes?
Yeah.
Okay, consensus.
Yeah.
All right. So why do we believe that?
Well, because most people don't itemize, right? And so there's a very small percentage of individuals that actually itemize. And so in order for this to actually impact you, right, you need to be able to itemize. And so I think that just that alone, basically, most of the population isn't going to be affected at all.
Yeah, for example, the standard deduction for an individual is $15,750. So your itemized deductions, which includes your gambling losses, have to be more than that amount for it to even make sense. And if you're married, the standard deduction is $31,500. And so your itemized deductions have to be over that amount for it to make sense for you to make that deduction. So
Yeah, the percentage of individuals that actually itemize is low. It's roughly about 15% of individuals actually itemize their tax returns. And then there was a study that showed that on those itemized deductions, only about 1.2% had gambling winnings on it. So out of total population that actually had gambling winnings on itemized deductions, 1.2% of the total population.
I think that stat was for all taxpayers.
Yeah, all taxpayers.
So it doesn't matter if you itemize or if you take standard deduction, only 1.2% of the taxpayers in America
Yes.
have gambling winnings.
Yes.
And they
There's
just
a
all happen to
chance.
be here.
Yeah.
No, I'm just
At this table.
stay tuned.
Yeah, the next
That's another
podcast, how we're doing it.
1.2% gambling winnings. So you're not even getting to deduct. Most people aren't getting to deduct their losses. Why the random? It just kind of feels random. Why 90%?
Well, that's because of the reconciliation bill that had to be done, right? And so essentially, they had to take a loss somewhere, right? They had to show some sort of budgetary impact, and right, they basically last second threw this in there in order to be able to make it happen. So it was basically just a way for them to be able to satisfy the bill passing.
Yeah, I think they did a calculation to determine really kind of what the revenue benefit would be for federal government. And so they determined that this could potentially provide an additional $1 billion of additional revenue over a 10-year period of time. And we know what the deficit is currently.
No, we don't. It just changed higher.
I just hit
right now.
It just switched.
Oh, wait, right there.
It just switched.
Higher.
And so, that is a spec regarding what the total deficit is right now. So it's interesting, to say the least.
So most people, of those 1.2 people that have gambling winnings, I think it stands to reason that most of them are recreational gamblers. How does this impact, or is there a difference between professional gamblers and recreational gamblers as far as the 90% cap?
No. So whether or not you're doing it for recreational or you're professional, the 90% limit still applies to professional gamblers. Yeah.
So why is that distinction important between professional and recreational? What's the difference?
Well, professional gamblers can potentially write off some of their other expenses, entry fees, any other sort of auxiliary costs that they may incur for their wagers. And so there's just a slight little deductions that they can actually itemize through their business aspect of it all.
Okay. All right. All right. So I'm curious because, in preparation for this, we looked up session rules or whatever. So, in other words, the example is, all right, I go to Vegas and I bet on my Cowboys to win the Super Bowl, and they do it. That's right. It's going to happen eventually.
He said it.
Eventually.
Long futures bet.
I win some money. Yeah. I win some money in February, whenever the Super Bowl is. And then
We don't make it that far, but yeah, keep going. We're following along.
I'm living in a fairy tale world right now, guys. All right. Okay. So they win the Super Bowl. I win a lot of money. I'm on a high horse. So a few months later, I go back to Vegas and I just blow it all. How does the per session rules apply? Like, can I offset the losses from a different trip with the earnings from another trip?
Yeah. So the way the IRS determines this is, so each session, from a calculation aspect, is you want to determine a net return for those sessions, but all those sessions for the entire year qualify for a net return as well too. So when you're keeping track of all this stuff, you do want to keep track as far as net returns per session. So different points in time that you're gambling, different points in time you went to Vegas, or you went to the Bahamas for a trip, or whatever the case may be, wherever you had some type of gambling experience. Each one of those sessions, you want to calculate a net return. But in overall, you're going to take all those net returns and determine your annual net return. That annual net return is going to help calculate what your gains and losses are, and then the tax implications are going to be on whatever that total.
It's really important what he kept saying, keep track, right? Because I think that's something that's very important in order to actually be able to be one of the 1.2 individuals that can actually, I don't know who these unicorn winners are, but they're out there. And I think it's important to keep track of through some sort of ledger, some sort of player's card, some sort of documentation to be able to take to the your tax preparer to be able to say, hey, I actually won, or more than likely I lost, and be able to show them exactly what it looks like.
Yeah, if you are one of those 1.2% and you have a Discord channel, hit us up. You mentioned earlier, you said for right now. What did you mean by that?
Well, there is an uproar, and so they're already trying to work and introduce new legislation to completely get rid of this new provision in the bill. Yeah. So just like that.
They want to go back to 100%, right?
Which means there are probably many individuals that missed that little part in the bill when they voted on it. My assumption.
It's impossible.
There's no way, right? There's no way.
Sign here.
So in other words, stay tuned to our podcast. We'll keep you up to date. Yeah. Okay. So this is federal. Mm-hmm. How does this interact with state income tax? Was there a change in that?
We always don't get along. I mean, it's the United States of America, but sometimes, especially when it comes to gambling, this is federal law, but states have some states have state income tax, and for some states like Connecticut, which has Mohegan Suns and Foxwoods, they do not allow you to deduct your gambling losses from your gambling winnings from your state income tax. This is for federal taxes. So even though some sort of gambling is allowed in your state, you still have to check if it's deductible from your state income tax.
Basically, you're going to get taxed on all your winnings and don't get to report any of your losses.
Yeah, and you have to. Gambling is legalized in I think 38 states now. So that's a lot of states that they're allowing you to legally bet on pretty much everything. Yeah. And then they're saying, any of those losses, though, they don't matter. And I'll only take into account whenever you win. And a lot of these states, some states do still allow you to do so, but a lot of these states are still not allowed.
I don't know, man. If you include lottos, I think that's like 48 states, all but 2. I can't believe Hawaii is one of them.
Oh, lottery's gambling? No way.
All right, we probably should discuss that. What is considered gambling?
Slot machines, card games, poker, sports betting,
horse racing,
dog tracks. Anything.
No, I love the ponies.
You mentioned 38 states it's legal.
Yeah.
So in 2018 we started seeing that change.
Yep.
So I think of a state like Michigan, the roller coaster those people have been on. So I can't deduct my state. I can't deduct my gambling losses on my state income tax. Yay! We have legalized online gambling. Federal One Big Beautiful Bill Act comes in. I can only deduct 90%. So, I mean, it's a roller coaster.
Yeah.
They did get legalized gambling in Michigan, for example. So now they can do stuff like DraftKings and stuff like that. I think that's or daily fantasy.
Daily
rather.
fantasy, things like that. Yeah, that's where I think a lot of the market's driven to now is this accessibility and ease, which has pushed a lot of individuals into really a lot of sports betting. There's other online applications, things like that, to be betting on other formats of gambling, but really sports betting because of these online platforms for daily fantasy, and now also adding in prediction markets as far as a form of investing, gambling, something to provide to add additional part of revenue for some of these.
I think it's important too, just with the DraftKings in general, or just a particular site such as that the ease of entry into it is so low compared to a lot of casinos or other forms of gambling where it's a lot higher dollar amounts in order to participate. And I think things like that are having a negative impact, right? Especially on the younger youth, right? Because $5 here, $5 there, right? After a while, it starts adding up, and I think most individuals don't even realize, right, that most sports bettors lose. They don't win. Therefore, right, if you're doing $100 a week, that's $5,200 a year, right? That's $5,200 that can be going towards other type of savings accounts, retirement accounts, debt, other things. So I think it's important for the people to actually keep tracks of their wins and losses.
Okay, we're in Texas. You can't open an account on one of those daily fantasy sites, right?
No, I think you can open up accounts on there as far as actually wagering is different.
So those daily fantasy sites are available they're federally approved, those daily fantasy sites. There's no like MGM sites and things like that where you have full casino and sports betting and stuff like that. But daily fantasy is available from a federal aspect. It's ruled differently, so you're allowed to do it everywhere.
Yeah, that's a good point. So you're allowed to do daily but you're not allowed to use other functions on those kinds of sites.
Yeah, they limit you based on the state that you're in. They limit you as far as what you're actually allowed to gamble on. So like the daily fantasy stuff's no problem because they view that as a different format of gambling, which is interesting. But there's other formats that are legal in most states now that some states you still are restricted from utilizing.
Yeah. Okay. So offshore gambling is a thing.
Big time. Yep.
So do we think that this is going to increase, drive people that way, like the new tax law, or the fact that some states don't have legal gambling? Do we think that that's going to increase offshore gambling?
Yeah, I mean, I would assume so, right? The implications now based on the new tax laws, and then there are still 12 states that don't allow or don't have legalized gambling in those states. So, that compounds to individuals trying to utilize other additional resources that are not going to be tracked or not going to be reported specifically, that can allow them to still participate the way they want to.
Yeah. So in other words, there's already a lot of gambling income that's not reported. So if you're not reporting it, you can't even write off the losses. So that 10% reduction is kind of
what's the point?
Yeah. No foul.
No.
Well, that's a good point. Even if you're not getting a W-2G from the institution casino, you still have to report your gambling winnings. And to your point, not many people are doing that. Yeah.
Mm-hmm.
Okay, you mentioned prediction markets.
Yep.
Some people think that maybe this law can drive people towards prediction markets. What are prediction markets?
It's a way for individuals to make binary decisions for future events, right? And so what it allows you to do is to purchase what are called contracts. And typically these contracts are sold cents on the dollar. So for instance, if you wanted to, you could make a prediction whether or not the Federal Reserve is going to raise interest rates in September. That is a binary decision. Yes, they are. No, they're not, right? And so if you wanted to, you can go on to multiple different websites and you can make a decision as far as whether you believe that's going to happen or not. So the way it would work would be could be a contract that's offered for 25 cents that says the Fed are going to raise rates. So you can go in there, buy 1,000 contracts at 25 cents. That's a $250 purchase. Now what happens is that when the time comes, Fed makes a decision. At that point in time, they decide, yes, we're raising rates. Awesome. Your $250 purchase is now worth $1,000, $750 gain. If the Fed at that point in time decided, no, we're not raising rates, then that $250 investment is now zero. So now you just lost $250. So these prediction markets were established, fairly recently. I think it was back in 2021 is the first time they saw these prediction markets come into fruition, and they become extremely popular. And during that time frame, we're seeing it being utilized for so many different things, right? Sports, economical things, presidential elections, right? We're seeing it utilized for different things, but we're in a really weird scenario right now because there's no true understanding as far as how to determine what it is from a tax perspective, and that's where we're trying to figure out. IRS has not come out and said this is taxed a certain way yet. And so understanding how that works and understanding the differences between the way investing taxation works, the way gambling taxation works, and the way these prediction markets work, it's really important. And if someone's telling you that they know exactly how it's taxed, they're lying, because we have nothing concrete in how that is.
So I think it's worth noting that the IRS hasn't taken a position. And one of the reasons is because courts are still trying to decide if this is considered gambling or if this is considered an investment, if you will. So are prediction markets subject to that 90%?
No, as of right now. Yeah.
Yeah. I think the answer is we don't know.
Right.
We don't know. If it's gambling, yes. If it's not, then no.
That's a good question, because that's part of the uproar, because automatically people are thinking that these are subject to the 90% rule. And as of right now, we don't know.
Yeah. Investments are treated, and we've discussed this in the past, right? You buy a stock today, you buy Apple today, and you sold Apple in 5 months from now. If you had a gain on Apple, there's a capital gain there, or there's a short-term capital gain there that would be considered ordinary income. You buy Apple today and you sold Apple 5 years from now, long-term capital gain. Right now, the way that these prediction markets work, most of these are done in short periods of time, right? And so people are saying, well, this is investing, so it should be short-term capital gains, or hey, I did a prediction for 2 years from now, it should be considered long-term capital gains. We don't know, right? And that's the issue with these court cases. They're trying to determine whether it is investing. It's one thing. If it's not, it's gambling. It's one thing. We've even seen some articles where they're recommending to treat it none of either, right? They're recommending to treat it as miscellaneous income. And if that's the case, that goes on your Schedule 1 as miscellaneous income. And so if that's the case, you're taking on income no matter what. Any net profits that you have, whether it was short, longer term, it doesn't matter. It's all going to be considered income. So that's another stance that a lot of people are taking that's different than whether it's gambling or whether it's an investment.
Yeah, and that miscellaneous income would be subject to ordinary income rates as opposed to more favorable capital gains rates, right? Yeah.
Right.
And I think it's also worth noting that those court cases are they're really trying to determine if it's gambling or investing, so they know who the regulator is going to be. It's not necessarily to see what the taxation is, but that'll be an offshoot, right? That's what IRS will.
Yeah, and I think some of these, like Kelchi and Poly market, some of these, prediction markets, some are offshore, exchanges. Some are in the United States, right? So there's a lot of nuances in regards to how it should be taxed because of those specifics as well.
I'm glad you went there. Can we talk a little bit about the nuances of those sites' tax reporting?
Yeah.
Like the forms that they provide or don't provide.
It's crazy because you can go on the Polymarket website, and on Polymarket, they go through and they're adamant, hey, this is investing, right, from their perspective. So from their perspective, everything goes on a Schedule D, which is different in regards to the way that other people interpret. Because for Kelchi, they're taking it as a more conservative approach. You get a 1099 miscellaneous from them in regards to the net proceeds from your investment. So these are two completely different operating companies for prediction markets, both saying two different things in regards to the tax treatment of your winnings when it comes to.
Should be good. Should be fine.
They should know what to do, right? They're the tax professional.
Are both those domestic?
No, I think Polymarket is offshore.
Yeah.
And I think Kelchi's domestic.
So are they submitting any information to the IRS based on their users?
I mean, I doubt Polymarket is. The thing is like people were saying like I think last year there was I forget the number. There was so much money predicted on the outcome of the election, and those platforms were the most popular platforms to do so, right? There was a large percent of individuals that got no tax forms from both of those companies regarding the outcome of their prediction when it came to the election. And so they did it, and there was an outcome. They won or they lost. But whether they got, that specific tax form that they needed to represent that from either of those companies.
I think Credo made a point earlier about just making sure to keep track of your winnings, losings, and just because they don't file a report doesn't mean that they didn't send it to IRS going. So, right, if they're offshore, high probability they're not sending to IRS. If they're onshore, right, in the U.S., they're more likely going to send some sort of reporting. Uncle Sam wants to get their taxes.
Well, yeah. So that means it's probably safer to go to treat it as with the least favorable route.
Yeah.
As short-term ordinary income.
That's a personal decision.
Yeah. I think so.
Yeah. All right. So, okay. Can you talk about, you mentioned least favorable. There's still a way to minimize that though, right? Like, do I have to report so we talked about earlier, the losses are considered itemized deductions, which are below the line.
Right.
But the income is above the line.
Right.
Okay. Is there a way to still minimize the winnings? Like you were talking about a netting process.
Yeah. So each one of those individual companies, they're tracking all of your purchases, right? So with these prediction markets, so they'll have a net total for the year of what you've made or lost in that time frame. And so, if you're doing, let's say you're doing different predictions all throughout the year, they'll have a calculated total net return of all the ones that you lost and all the ones that you gained. And on that, like for Kelchi, for instance, on that 1099 miscellaneous, it'll have a net total, whether that be a loss or whether that be a gain on that net. Actually, I don't think if there's a loss, I don't think you get 1099 miscellaneous form. I think you only get the 1099 miscellaneous form if there's a gain. Then you have to report it as income. So yeah, that helps because they are tracking that for you. But it doesn't matter. Like if you lost, it doesn't matter. There's no benefit. Right. You don't get to write it off for other purposes. But if there's a gain, it's ordinary income that you have to report it on the Schedule 1.
Yeah, just wanted to expand on what least favorable route means. If you treat it as a gambling loss, you can deduct up to 90% of your losses. If you're treating this as an investment on Schedule D and you win and you treat it as a capital gain, you can use capital losses to offset your capital gain. But if it's Schedule 1, it's ordinary income. So that's what we mean about taking the least favorable route, just in case the IRS does go back and has a determination. So,
yeah,
I think the IRS likes more taxes.
So I've heard.
Yeah. I got you, Iris. I'm safe.
It seems like the IRS wants to have, but I don't know about our government. Anyway, okay, sorry. That's right. I said it. So I think it's worth mentioning, because you're talking about reporting, right, from the institution. I think it's worth mentioning there was also another sneaky little provision in the One Big Beautiful Bill Act that some people are of the opinion that will require casinos to increase their reporting threshold from slots. So there might even be fewer people claiming winnings.
Yep.
So that's why we think the 90% cap is much ado about nothing for the majority of people. I think that's fair to say, right?
I think so. Yeah.
Unless you're like my in-laws that happen to just win a $5,000 jackpot at the casino, right? So I gotta talk to them about this now.
Hey, look at that.
How many other times did they go to the casino this year, though?
Oh, dude, they go all the time. They go all the time.
All right, so let's wrap up with some real world strategies. So to that point,
I guess like financial planning stuff.
sure. let's say we were to go. All right, let's say we were to go to a horse track next week. Let's say hypothetically, and I win a bunch of money, but you guys lose everything.
You could have my tickets.
How are you? Y'all talk about keeping track of stuff and record. Like, so what does that look like? Like, am I writing down like, okay, $1 on this horse, or what does it look like?
I would definitely tell you that it'd be ideal to keep track of receipts, right? Receipts would be one way to, whatever your wager tickets are, right? Putting a W or an L, maybe putting a dollar amounts on there, right? Those are simple things at an event like that. If they happen to have some sort of player's card or some sort of other particular way to track at that particular horse track or casino, right? Those are other ways, right? Player cards are what we refer to normally, right? Those are easy ways where they kind of hand off, right? Otherwise, you're having to do it yourself.
I mean, you can keep a ledger, right, of each session. We discussed sessions earlier. You can keep a ledger of each session of how much you're inputting and what the output is per session, and then calculate it over time. And that can be something done, manually. But yeah, these player cards, there's so many incentives for using these player cards now. But the reason they incentivize utilizing it is because it's so important for these casinos to track every bit of data possible. And so they're going to have all the information you need. So you can easily go, especially if you're going to that one specific one regularly, you'll be able to go to them and get reporting as far as what your net winnings, losses, whatever the case may be for the year. So it's an easy way to determine and show proof of what the total was and what you spent. Specifically for gambling purposes.
Just like anything else for tax reasons, right? You need to make sure you have some sort of documentation, right? You can't just say I lost $1 million because I'm not a very good sports bettor.
Yeah. That's
I'm actually
believable.
pretty good.
I was going to say that's believable.
Wait, no, we know. We know. It definitely happened.
Yeah, the only way to win is to be random, right? You can't keep playing. If you keep playing, you're going to lose.
Yeah, I mean it's the case, right? I mean, you cannot compare gambling to investing. You can't, right? We've talked about in the past the benefits and probability from an investment perspective, right? So, in the circumstance here, right, in almost majority of individuals are losing anyways, and then add all these other nuances of how to report this from a tax perspective. The idea that this is such a big deal is so silly.
The House wins again.
The House of Representatives?
Sure. Them
Okay.
too.
All right. Good stuff, guys. See you on the tables.
Or on the track.
God, don't get me excited. Come on.
Thanks for tuning in to another episode of Our 2 Cents on Your Dollars. Please make sure to follow, like, and subscribe. Thank you for joining us on Our 2 Cents on Your Dollar, proudly presented by Strategic Insights. If today's conversation brought you clarity, please pass it along, and don't forget to subscribe, share, and check the description below to learn more about us. Until next time, stay informed, stay invested, and stay strategic.